we have already discussed about the two classes of shares, that is preference share and equity share. The third one we have to discuss about, that is set equity share. That is not another class of share, but it comes under equity shares. Section 54 of the Companies Act 2013 allows a company to issue equity shares at a discount for providing certain rights in the form of intellectual rights or providing know-how for the company. So, equity shares which are issued under Section 54 of the Companies Act 2013, these shares are issued at a discount or they are issued for consideration other than cash. These shares are issued to those persons who provide technical know-how or right in the form of intellectual property rights, or by whatever name called, or value additions by whatever name called. These are called set equity shares. For issuing set equity shares, there are certain conditions to be fulfilled. So, the one important point I want to tell you, set equity shares are provided to those persons who provide technical know-how or certain right in the nature of intellectual property right. There are certain conditions to be fulfilled for issuing the set equity shares. First point you have to remember is, it is authorized by a special resolution passed by the company in the general meeting. For issuing set equity shares, a special resolution should be passed by the company in the annual general body meeting. The resolution should specify the number of shares that can be issued as set equity share, what is the current market price, what is the consideration, if any, to be received, and the class of directors to whom such shares are to be issued. All these should be mentioned. So the first point is, a special resolution should be passed by the company in the annual general body meeting, annual general meeting. Second point is, the resolution should specify the number of shares, the current market price, the consideration, if any, to be received for issue of shares, then the class of directors to whom such shares are to be issued, to whom those shares are to be issued. Then the third point is, the special resolution should specify the number of shares to be issued as set equity share, then current market price of the share, then consideration, if any, to be received. How much is the consideration to be received on such share? Then the class of director or directors to whom such shares are to be issued. All this should be specified in the special resolution. Then the third point is, not less than 1 year has elapsed since the company is entitled to commence the business. So, set equity shares can be issued only after not less than 1 year has elapsed at the time of issue. The company is entitled to commence business. These conditions these three conditions are to be fulfilled in order to issue set equity share. Now I want to deal with a stock investment scheme. Stock investment scheme. There are certain difficulties which are faced by the shareholders when they apply for the shares. Sometimes shares may not be allotted. Then they have to get the refund from the company. There may be undue delay in getting the refund from the company. In order to mitigate the difficulties faced by the shareholders, this stock investment scheme has been introduced by the company. This stock investment scheme, that is an additional facility available to an intending investor in case he opts. Additional facility available to an intending applicant. that is stock investment scheme. Let us see how this stock investment scheme operates. Some selected branches of the bank, they may offer this stock investment scheme, or stock invests are issued by selected branches of some banks. An intending investor who wants to obtain stock investment facility, he has to open a bank account in a selected branch by depositing an amount with the bank. So the first step, the intending investor, he has to deposit some amount with the bank. When amount is deposited with the bank, a blank stock investment of the desired amount. Suppose you have invested some 50,000 rupees, and your desired amount is 30,000. Then blank stock investment will be given by the bank against these deposits. Blank stock investments will be given, that is an instrument that will be given by the bank against these deposits made by the applicant, by the depositor. The stock investment will be given by the bank, duly signed. It marks the date of issue, and simultaneously there will be lien on the deposit. The stock investment, that will have the amount for which the stock investment has been given, that will have a lien on the amount of deposit made by the applicant with the bank. The investor who wants to apply for the share, he will give the application together with the stock invest. He will give the application form duly filled together with the stock invest and send it to the collecting banker. This collecting banker will be nominated by the company. So these application forms together with the stock invest, that will be given to the collecting banker. The company will encash the stock invest of those applications or of those investors whose applications are successful, or to whom shares are allotted, their stock invest will be encashed. And for certain applicants, shares may be allotted in partial. Their stock invest that shall also be encashed. The stock investments of unsuccessful applicants, that means for whom shares are not allotted, that will be returned to investors without encashing, and they can surrender, these applicants can surrender it with the bank, so they can lift the lien given on their deposit. So what I shall explain, what is the purpose of this stock invest scheme? Stock investment scheme is given to protect the investors from undue delay in getting the refund on application money. If the shares are not allotted, their application money has to be refunded. There may be some delay, undue delay for receiving the refund on application money. So this has been introduced by the government. This stock invest scheme is to protect the interest of the applicants, intending investor. This can be treated as an additional facility. It is not a must. It's an additional facility to the intending investor if he wants. How this scheme operates, that is important. That is what you want to understand. How this scheme operates. Scheme means the stock invest scheme operates. Stock invests are issued by selected branches of some banks. It will not be given in every branch. There are certain selected branches of every bank. Some banks. The investor who wants to opt for stock invest scheme, they have to deposit an amount. They have to open an account and deposit some amount with the bank. With the bank which issues stock invest. First open an account with the branch which gives the stock invest scheme, then deposit the amount. Once you deposit the amount, then blank stock invests. Blank stock invests are issued by the bank to the depositor or investor. This blank stock invest is given against the deposit made by the investor. Then this blank stock invest gives the details as it should be duly signed, date of issue, then it will have a lien on the amount of deposit. Lien on the amount of deposit means that can the bank can take, the company can take, the bank can use this amount against the application money. That's it. There will be lien. Then while the investor applies for the public issue, he has to submit the application together with the blank stock invest. Then blank stock invest, after filling it, that will be given to the collecting banker. Collecting banker will be given by the bank company, and they have to submit it to the collecting banker. Suppose the shares are not allotted for unsuccessful applicants, this blank invest forms will be, or blank stock invest that will be returned. For certain applicants, it may be partial allotment may be given. For those who are not given, for unsuccessful applicants, this stock invest they are returned. They can give it to the bank, and when they give it to the bank, their lien on the deposit that will be withdrawn. This is the procedure to be followed in the operation of the scheme. Next point which I want to deal with, that is book building. Book building. What do you mean by book building? The term is book building, a technique used by the company for marketing the public offer of equity shares of a company. A technique used by the company to offer public issue of equity shares of a company. A way of raising fund or capital from the market. Now, free pricing mechanism has been accepted by the SEBI. After that, this book building has much significance, and it is a new lead development in the capital market. It has given a new lead in the capital market. So after having accepting free pricing mechanism by the SEBI, this book building has given a much lead in the capital market. Then, how this book building mechanism operates? The most popular method of book building is, first, the company will appoint a merchant banker. This merchant banker is also called as book runner. A company which wants to make initial public offer, they will appoint a merchant banker. This merchant banker is also called as book runner. The company will mention the number of shares it intends to sell, and also mentions a price band. How many shares they intend to sell at a time, and the price band will also be mentioned. There will be a floor price fixed. The intending buyers or the intending investors, they have to submit their bids. when they submit the bids, it should be above the floor price. The purpose of fixing the floor price is when the investor submits his bid, the price that is submitted, it should be above the floor price. There is a period for book building. Once this period ends, once the book building period ends, the book runner, he will evaluate the price on the base of the price received, investor quality of the investor, the timing of bids. All these will be evaluated by the book runner. So book runner will evaluate the price, then investor quality, then timing of the bids. All these will be evaluated. Then the book runner and the company will conclude the final price on the basis of these 3 points. That is the price of the bid, then quality, timing of the bid, etc. The company will determine the price at which the company is required to sell them, is prepared to sell the security on the basis of the bid, and they will allocate the securities. Number of shares to be allotted, that will be fixed in advance. That will be fixed, and the issue price gets determined on the basis of the bids, on the basis of the price that has been quoted through book building process. So I hope I shall summarize once more. What's the procedure for book building process? Book building process, a technique for fixing the price of the security. The first step that is taken by the company is to appoint a merchant banker. He is also called as the book runner. The company has to do one thing: how many number of shares the company intends to sell, and what is the price band, minimum price, maximum price. That is a price band. Investors submit their bids, or their orders in book building. It is just like bidding at an auction. Auction bidding poleയാണ് this is done. Investors will say the price, will submit their bids. Once the period of the book building period ends, then the merchant banker and the company will evaluate the price, the investor quality, the timing of bids. All these will be evaluated, and on the basis of this evaluation, the number of shares to be issued and the price at which they are to be issued, they will be fixed. What are the advantages of this book building process? There are certain advantages for this book building process. The most important advantage is you can find the price at which, the maximum price at which the public is prepared to take the share, and also the demand for the share. Demand and price of the share, that can be discovered. The cost of issue, that is much more than the traditional method of raising capital. Then the entire process of issuing the shares, time taken for issuing the share, that is much less in the case of book building process. The demand for the share under book building process, that is known before the issue closes. Suppose the demand for the share is very low, then the issue can be deferred, then the issue can be rescheduled after knowing the trend of the market. These are considered to be some of the important advantages. What are the advantages of book building process? Demand and price can be discovered. Cost of issue much more than the traditional method. The time taken for completing the issue, that is less when compared with the normal public issue. The demand for the share can be known in advance before the issue, before the book building process closes, before the issue closes. Because suppose the demand for the product is less, then the issue can be postponed to a future date when the market improves. These are. Now I want to explain what is employee stock option scheme. Employee stock option scheme. Employee stock option scheme. This is an option given to whole-time directors, officers or employees of the company. Option given to employees, directors or officers of the company